people, and I want to say this very clearly, believe that the silver market is the retail silver market. It is not. The retail silver market can have shortages. That's a subset of the big silver market, which is the derivatives market, which is tied to commercial 1,000 ounce bars. So you could have enough 1,000 ounce bars sitting above ground in storage, owned by different entities, and still have a run on silver eagles that are a subset of the silver market, and people believing that we're out of silver because there's a $14 premium on a silver eagle. Not true. The truth is there's a $14 premium on a silver eagle because the demand for silver eagles far exceeds the availability at that time.
Hello everyone and welcome to another edition of CEO and Market Expert Interviews. I'm your host Lucian. Most of you know me as Triangle Investor from social media. Today we are joined by David Morgan, publisher of the Morgan Report, a person who I always enjoy talking to. David, thank you for being here today and welcome back, sir.
My pleasure. Thank you.
Thanks, Dave. A lot of things to discuss today, but maybe I would like to start with gold and the article I've read yesterday. And I saw you posted and commented on X as well. And that is about 109 billion in US gold reserves now in question as German officials demand to count bullion bars at New York Fed. How do you see that story unfold? That's very intriguing, actually.
Well, it fits into, I think, even the bigger picture, as you're well aware of, and this was the audit of the Fort Knox gold. And so this is basically a subset of that. And this is somewhat conjecture. So we got the news that, the Fort Knox gold should or could be audited soon. And many people that aren't in the gold industry don't realize or didn't know the facts that the amount of gold at Fort Knox is not the total amount of gold the U.S. purportedly owns. Many people think that all of the gold owned by the U.S. is in Fort Knox. Not true. So that we dispelled that, me and several others. And as we were seeing this drain, so this is a little off the top, well, it's on the topic, but it's part of the story, was there was a big enough arbitrage between the London gold market and the New York market, the COMEX, for gold to physically move across the ocean. And that was taking place. Silver as well. And as that began, now this is conjecture on my part, but there's circumstantial evidence that backs this up.
Sure.
More and more people that saw this gold moving started to say, no, wait a minute. If somebody's asking for their gold back, which may or may not have been the case initially, just moving it for the spread to make money, and also to have gold positioned prior to a tariff, which didn't happen, but they didn't know that at the time. So a couple of reasons to move it: an arbitrage opportunity and fear of a tariff being brought about on gold and silver. Didn't happen. But what did happen was people started to see that, and then they said, well, me too. And the me too were the Germans. I said, wait a minute. If they're looking to get their gold or put it into whatever facility, maybe I should look at what I've got. You know what? I want my. So what happened was people started to what's called repatriate their gold. I own it, but you store it. You don't store it for me anymore. And since I own it, send it to me. It's that simple. And now there could be a problem. Well, how do we send it to you? Now, this occurred several years ago. I don't know if it's as long as 7. I have to look it up. But probably around 5, maybe as long as 7. Germany had actually asked for their gold back at that time, and there was a delay. And then if you talk to people in the industry like Jeff Christian of CPM Group, he said, well, check the contract, which I didn't have it in front of me and I don't have access to it. But he claimed that the contract was they had several years to bring the gold back. Might have been, I'm sure it was rehypothecated once or twice or 10 times, who knows. But it could be used as collateral, could be used as a swap deal, it could be used, in a negotiation. So that could well be true, that it's their goal, but you get it back on the terms you agreed to, which is over the next 3 years or what have you. That isn't the case here. At least it doesn't appear to be the case here, which goes right to your point. I know it took a bit of a long-winded explanation, but these are important because, you know, a deal's a deal. If I loan you my gold for 2 years and all of a sudden I want it back and I jump it up and down so you won't give it to me, well, that's only half the story. The true story is that, wait a minute, we have an agreement that you get to keep it for 2 years. So I don't get it back. And if I do, I have to pay a big penalty or whatever. So I want to stick to the facts, but it is concerning, and this will mount, I believe, because with this, we questions unanswered. Who else is going to step up and say, you know what, I want my gold back as well? I'm storing it with you, Mr. Fed or Mr. LBMA. Send it home.
Very interesting. Dave, in our prior interviews, we discussed financial reset and its inevitability. How much closer are we today to a financial reset, and is there a way to stop it? I know it's a big question, but
Well, it's a great question. I spent my whole time on stage at the New Orleans Gold Conference. That wasn't a few months back, and my presentation was on the new monetary system. And I went right to the top because the top is the Bankers Bank, better known as the Bank of International Settlements. I took everything off of their website, so it wasn't like I made up anything. It was fact after fact after fact. Going through that presentation, I tried to simplify it. It's obvious that the Bankers Bank wants to have basically a one, I wouldn't say a one world currency at this time, but a digital currency that clears through them. In other words, that all these banks are in alignment as it exists now. You know, it's just it'll be modified, and I can't give you the specifics. I don't have the slide deck in front of me, but basically, it's what we've talked about in the prior interview, that there'll be one central authority, the Bank for International Settlements. Everything will be done by what's already been signed, which is the ISO 222 agreement, which regardless if you're BRICS or not BRICS, you're going to clear through the same facility, which makes me question how powerful is the BRICS really if you're all going to, at the end of the day, clear through the same clearinghouse.
yeah, Dave, I really enjoy your views on gold, but the part that I love the most is silver when talking to you. Let's start with silver. Do you believe that the safe haven demand for silver will be significantly higher in the short term due to worries about the stability of the US Treasury market and trading wars?
I do. It's very difficult for me at this late stage, or maybe the last decade, to be objective about silver, but I still strive to be as objective as I possibly can. And what I do know is that silver is a safe haven. It's certainly not the same status a safe haven as gold. But as gold gets more and more expensive, more and more people will be priced out of the gold market. So, you know, if you have a transportation need, you know, you might want to buy that shiny brand new car, you know, and have a warranty and not worry about any repairs. But if you can't afford that, you're probably going to buy the best used car you can in the best condition you can find. And that's kind of an analogy for going from gold to silver. So as this uncertainty continues, more and more people, I would say, be forced into gold or forced into silver rather, but they'll think gold is out of my range. I really think silver is the next best thing. I'm going for some silver. So I really do think that this next leg up, and we're pausing now due to the tariff questions, uncertainty in the stock market, reallocation of assets. You look at the commercial real estate sector in the United States, it's in dire straits. No one talks about it much. You look at the stock market, even though it's oversold on a technical basis on a small time parameter, from a long-term time perspective, the market's overvalued by almost every metric you can name. And further, I did an update for our paid members, our premium service, and I thought it was, to me, one of the more profound updates I've done relative to stocks and gold, because gold is the most negatively correlated asset to the stock market, not gold stocks, gold itself. But what I did, and many of us do in this analytical thought process, is I looked at the S&P 500 on a gold only basis. So how does it rank up against gold? Well, for the last 20 years, we're in a massive head and shoulders formation. The peak of the gold market, or the head of the head and shoulders, is at year 2000. So you're looking at a left shoulder ahead in 2000 and a right shoulder that's formed here 25 years later, and it's coming down in terms of gold. And I really think that we are starting to begin the move out of equities and into commodities. We're going from stuff we want to things we need. We need sugar, cotton, cocoa. We need lumber. We need foodstuffs. We certainly need silver in a high-tech society. We need copper. So that's, I think, the shift that's begun. I mean, I'm going to drone on a bit longer, but I talked about the run to gold, and it probably started that about 2 years ago, maybe a year and a half. And I said it's begun, but it's begun in a stealth mode. And how did it begin? With the banks. The banks started buying more and more gold. And now you see banks don't want to have the treasury exposure that they have. And where are they putting that money? Gold. So this will spill over into silver as it, I guess you could say, trickles down into the man on the street that says, wait a minute, I'm losing my savings. My paycheck isn't covering my expenses as well. But gold and silver keep moving up. I'm jumping on board.
Yeah, yeah, agreed. We cannot avoid the topic that is always here when we see silver price moves in both directions, down and up, and that is the manipulation story. My question to you, to what extent are the silver paper market and physical market disconnected?
Yeah, that's a great question. And it's really difficult to answer as effectively as I would like to. So, one of my most broad statements I've made for years, and I haven't said it in recent times very often, is that the long term trend cannot be manipulated. So, the long term trend in gold is up, and the long term trend in silver is up. If you look at the beginning of this bull market, it started basically in 2000 for gold. Gold was 252 the ounce, round numbers, and it's at almost 3,100. And that in real terms is still quite a gain. Inflation adjusted is still quite a performance. Silver was around four something. It's at roughly 30. Performance has not matched gold's, but it's certainly gone up. Now, within that long-term trend that I don't think can be manipulated, certainly the price can be managed, a different word, within that long-term trend. And we see that over and over again. There's been many lawsuits just put in, silver spoofing into a search engine of any type, and it'll bring up several articles in the New York Times, Reuters, and other places that are valid, showing that banks have been penalized for what's called spoofing the silver market. Now, if you get really legal eagle about it, and you talk to some of the more apologetic people on the banking side, they'll tell you they never manipulated the market. And if I put on my lawyer hat, I'll have to agree with them. Why? Because of all the judgments that come down, the word manipulation has never appeared in that. Spoofing has appeared. Now, if you believe what I believe, that spoofing is part of the manipulation, then you could say in layman's terms it's manipulated. I won't get too technical, but you see the dilemma I'm kind of in if I want to, if I'm asked to testify, what would I say? Well, I'd be saying exactly what I'm saying to you. So the paper market is not as far removed from the silver market as some pretend it to be. And the reason is this: the derivatives price does work for gold and silver almost all the time. And if it didn't work, then we would see the physical market overtake the paper market immediately. But that really doesn't happen very often, because when the price is set in the derivatives market and you have $31 an ounce silver, you can get $31 an ounce silver off the exchange. So if the system was broken, that wouldn't take place. Now, there's subsets to that as well, because the contract says that you have to settle in cash if they say so. And I've had some what we'll call small players, big investors, but that have stood for delivery and gotten a letter from whatever their broker was under the CFCT rules. We're sending you a check. You're not going to get your silver. because here's the contract you signed. Now, how much of that goes on, I don't know. I don't make a big case out of it. Is it 1%? Is it 10%? If it's 1%, you can kind of ignore it. If it's 10%, yeah, that's meaningful. If it's more than that. So these are subtleties again that if I was asked to testify, and was given a free reign, which you're giving me, thank you for all the time. These are little things that very few people even talk about. But again, I want to remain neutral because it isn't broken yet, because the amount of deliveries are matched most of the time, with few exceptions. And the other part is that a lot of people, and I want to say this very clearly, believe that the silver market is the retail silver market. It is not. The retail silver market can have shortages. That's a subset of the big silver market, which is the derivatives market, which is tied to commercial 1,000 ounce bars. So you could have enough 1,000 ounce bars sitting above ground in storage, owned by different entities, and still have a run on silver eagles that are a subset of the silver market, and people believing that we're out of silver because there's a $14 premium on a silver eagle. Not true. The truth is there's a $14 premium on a silver eagle because the demand for silver eagles far exceeds the availability at that time. But as far as how much silver is available to make into silver eagles, it's more than sufficient. Hope I'm making sense here.
Yeah, you do. It's very interesting take, actually. That brings me to my next question. People see silver as a monetary asset, but could we see any circumstances where the countries adopt silver as a monetary asset?
Well, as much as any, I think the Europeans are more savvy to silver than the North Americans. Russia is the only country we know of that has bought both silver, platinum, and
Yes.
palladium recently. And I think they're the first. I think there will be others. Mexico, God bless them, but if Mexico just withheld, make a small number, 5% of their silver in the banking system, or maybe even a private entity of some type, a sovereign wealth fund for Mexico. That would do world of good for them because silver is very undervalued relative to gold and anything else you want to measure it against. And just by having that strategic stockpile, I'm going to digress for a moment. I'll try to make it quick. One of my friends from the web actually made a proposal for South American countries, including Mexico, and his proposal was that they hold back some of their silver supply for solar. That as things go forward, they will need to have more solar in their countries. And those are the best countries to use solar because they get so much sun. And when you're building a medium sized mine, even a big one, but for let's call a reasonable 10-year mine life, mid level producer, you could be far ahead putting up solar panels to get that thing into production than you would conventional, you know, wires over miles and miles that's never been there before. So there is an argument for that. It didn't get very far, but I liked his thinking to a proposal to, Argentina, all of South America, Colombia, Brazil, Argentina, Chile, Peru, all of them, saying, look, if you really want to give up all your silver, why don't you think about what you might need using it as an energy source?
That's great. Dave, to your latest models, to your latest knowledge, how much of silver shortage do we actually have today? And I want to also ask you about the silver inventories as we speak. So if you can expand on those two.
We've been here once before. Many people don't know this. I do, and others do, certainly not me. But there was a silver shortage or deficit, we'll call it, a better accurate word, from 1990 through 2005, inclusive. Every single year for 15 years, we had to eat the above ground stockpile of silver. So that is quite a record that most people aren't aware of. In that time frame, when I say silver, most of the time what I mean is commercial bars, 1,000 ounce bars. So it went from 2 billion ounces above ground lost 1.5 billion ounces that was eaten away. So we were left with 500 million ounces in 2005. And then the mining industry had enough above ground supply, had enough mining supply to start building the above ground mines, the above ground silver supply. I'm not saying that very well. Mining caught up to the deficit. We had an oversupply, if you want to call it that. So mining and recycling met all the demand with a surplus. That surplus built the above ground inventories. So we went from 500 million ounces back up to probably, this is a WAG. No one has a number. I don't care if it's the Silver Institute. I don't care if it's CPM Group. I don't care if it's anybody. None of us know the number, but I'm going to use 3 billion ounces. So now we have that many commercial bars, waiting for investment purposes, industrial purposes, or whatever. That's been eaten away at roughly 200 million ounces per year for the last 4 years. So there's a lot of above ground inventory that potentially could meet the deficit for a number of years going forward. The interesting part is things have changed. Between 1990 and 2005, not too many people were involved in the financial markets to the level they are now. The word silver and gold wasn't really known by anything except very sophisticated investors. And that deficit that actually makes people think wasn't really thought about very much in that 15-year time frame. This time is different because it will make a difference, and it will make it much more rapidly. Because back in 1990 to 2000, the amount of industrial usage of silver was 35% of the market. Today, it's over 60%. Some say as high as 70%.
Wow, double.
And the other kicker, which is really something to think about, is that 25 years ago, 2000, let's say, the whole silver market was 550 million ounces being mined. Today, it's 850 million ounces being mined, 300 million more ounces on an annual basis. So if you do a quick thought experiment, you just say, well, wait a minute, let's just say we leveled out at 550. That's 60% of a billion is about 600 million ounces. And yet, if we're still mining at 550, basically industry would eat every ounce of silver available. Now, I just did a thought experiment that's invalid. We added 300 million ounces more in the last 25 years. But my point is that we've leveled off now for several years in a row. And if we've plateaued at 850 for, let's say, the next decade, and industry continues the way it's going, without investment, demand will actually corner the silver market. So we'll go back to that same scenario that I outlined between 1990 and 2005, where we have to continue to eat the above ground stockpile. And now people are more aware of it. And perhaps someone such as Tesla, Apple Computer, Mitsubishi, some Samsung, Philips, who knows, comes in and says, you know what? Silver's pretty cheap. It's about 25, 28 bucks to get out of the ground. It's only 30 bucks. I think it's going higher. Let's stockpile your supply. Let's put that on our balance sheet. So once an entity or two that does that, it needs it for industrial reasons. There's just a copycat kind of a business idea. Others would most likely follow suit. So now you could have a competition for warehousing silver for future production that never really existed. Right now, it's still in just-in-time inventory. Call up whomever on the refinery side, say, I need this amount of silver, send it to me. I expect it, 3 weeks from now. Sure, no problem. But once you call up and say, that 3 weeks, we're giving you a heads up. It's going to be more like 2 months. If you want to buy now, the refiner does a courtesy call to Samsung, for example. Really? Oh, I didn't know that. Well, so see my point. The above ground surplus, if you want to call it a surplus, could be eaten up rather quickly with no one doing anything other than the status quo continuing, which is an assumption. But if you start to get investment demand, If you look at what's going on in the ETFs, I'm just doing a study before I was able to make our interview. But we go back to 2020, there was substantially more silver in the ETFs than there are now. Why is that? That's rather unusual because the algorithms usually catch these things early on in a new trend. And the new trend in gold has been obvious now for months. And silver usually will follow for a while and then it will actually catch up and actually exceed in almost every case. It should happen again. I can't guarantee that. Which means that people should be entering into the ETFs, the pros, the professional money, institutions, and they're not. That has me scratching my head a little bit. Why aren't they participating like they would or did during the COVID situation? And the answer is I don't know. I have some ideas, but they're too. I have to put on my tinfoil hat. I don't want to do that.
Yeah, Dave, what about gold silver ratio? What is it telling you right now? Is it that the gold is overvalued and the silver is undervalued? Or maybe the gold is fair valued and silver is undervalued? Give me some color on that.
Yeah, I think it's what you said. I mean, first of all, silver's undervalued relative to gold, but I think gold is getting to be fair valued. And that's, there's so many metrics you could use. I like to use the base money supply, or what the Austrian school calls the true money supply, and use that as a basis. And if you do that, you're looking at, ten to $20,000 gold. I'll be very conservative, say 5,000. So we're, a couple thousand from that point. And then a true gold silver ratio on a monetary basis is 16 to 1. I don't think it'll get there, but we've already been 33 to 1 in this bull market so far. Didn't last long, but that was the gold silver ratio. I expect that again. So if we got, I'll do $6,000 gold, so I do it in my head. But if you do a 30 to 1 at the top, you'd have $200 gold and $6,000 silver. And that makes sense to me. Now, whether or not that happens or not, I don't know. Certainly, silver is not acting as strong as I think it should be or could be, but the game isn't over yet either. And again, we could get in a situation that gold doesn't enjoy. Gold doesn't have a buyback program like a lot of stocks and industries have a corporate buyback program. They buy back their stock so much every year. Silver has that. 60% of the market is a buyback program every year because industry can't live without it. It's essential. There's no substitution. There's no stopping the solar industry. There's no stopping brazing. There's no stopping computers or cell phones or membrane switches or rear window defoggers in your automobiles. I mean, all this silver dependent things, there aren't substitutes for. So you have this buyback program. What else do you have? Well, you've got silverware, which is about 4% of the market. Hardly counts, but it's there. And then you've got jewelry, which ebbs and flows. And usually in high gold prices, silver jewelry does better because it's more affordable. So now the one off is the swing part of the market, which is investment demand or monetary demand. And so if you get institutions that have monetary demand for silver, or maybe even not monetary demand, silver doesn't care. Silver doesn't care if you buy it for industry or buy it for monetary purposes. A purchase is a purchase. So you buy it as a rank speculation. I hate silver, it's not money, but I'm going to speculate in it because it's the most undervalued thing and my algorithm told me to buy it. So I am, that kind of thing. It doesn't matter. The big purchase going into the ETFs could certainly move the market in substance, and that kind of could add on itself. And once we get above 35 and stay there, I think we're going to start challenging the old highs. Not the next week or next month, but the path to 50 will be far easier once we establish 35 as support rather than resistance.
Agreed, actually, on that. 35 and to stay a little bit on that level and then go higher. That's my take as well. Dave, final question: How silver mining companies? How would you qualify silver mining companies' valuation at this moment? Are they fair valued, or they are stuck in this general market volatility?
Yeah, I'm doing some charts on that right now. In fact, I was looking at them before our talk, so I'm glad you brought it up. If you're young, and what's young? I mean, it's relative, but you're 30 or 40 and under, and you have what we would call some moxie. You've got some risk tolerance. You're not lying to yourself. I mean, some people, oh yeah, I'm tough, and then As soon as the stock goes down 10%, they panic. Silver stocks aren't for you. Stay away. Find a different channel. But if you've got some good foresight and some time, I would say that the next Bitcoiners, it won't be as big as Bitcoin. I'm not saying that. But as far as a place to put money with very good gains will be in the silver miners. They are totally undervalued. They're hard to find. There's no such thing as a pure silver mine. Every silver mine out there is silver and lead zinc, silver and copper, silver and gold, silver and something. The reason they're silver mines is because when you do the accounting, when you do the financial statement, the most revenue comes from silver, not from copper. But it could be something like Hecla, which is a gold silver company. Depending on the price spread between a gold silver ratio, sometimes it's a gold company, sometimes it's a silver company. And so when you see, you know, a silver company, you want to actually look and see how much of the revenue comes from silver. Some companies are more leveraged to silver than others because 90% of their base is due to silver production and only 10% from base metals. Whereas some it's maybe 55% silver and 45% base metals. Not that that wouldn't be worth investing in. It's just that people don't realize how difficult mining is and how difficult it is to find a true silver worthy situation. There aren't that many, which makes my job hard and easy. It makes it hard to convince people to only buy the best, and it makes it so that's the hard part. The easy part is for a lot of people just to put silver on a piece of property and claim they're looking for silver and promote it. So you got to be a little careful between what's said and what is. And that's one of my jobs, to ferret out the real from the imaginary.
Exactly, and please remind my viewers how can they reach out to you and become your subscribers.
Yeah, there's a free list, there's a free newsletter, which we do all the interviews like yours, and thank you for your time. So go to themorganreport.com. The free list is right smack in your face. It asks for your name and an email. If you're interested in the subscription service, just go to the subscribe tab, and it's pretty well spelled out what we give for the money. And for the next month or two, I'm going to run a special, which I've been doing for about 3 weeks. If you become a new member, you will have a one-on-one half an hour consult with me, not one of my staff, me. And you can have the consult, you can buy the report, and you can look it over and take every stock pick I've given and decide after 30 days it's not for you. We part friends. You keep the consultation, you keep that one issue, and we're done. So it's a pretty generous offer as far as, try before you buy kind of thing. But I'm not going to take people that just sign up with their name and say, I think I'll buy it. No, you make the commitment to buy it, you can get your money back and you will get the consultation. And it's working out pretty well. And there are a few. I've actually had one this morning. Guy was 78 years old, very savvy, very knowledgeable about the markets, but he's too old to invest in the stock market. And we agreed on that. But still, I made a new friend and I helped him out. So, so be it.
That's great. That was David Morgan. David, thank you very much for coming to my show. I always really enjoy talking to you and look forward to host you again.
Well, thank you so much.